Welcome to Principles of Macroeconomics. Lecture 9 will cover some basic macroeconomic markets. First, we should understand some basic macroeconomic principles. We should identify a few important concepts before building a simple macroeconomic model. First, fiscal policy. This refers to the use of government taxation and expenditure policies for the purpose of achieving certain macroeconomic goals. For example, a stimulus package would be one type of fiscal policy action. Monetary policy is the deliberate control of the money supply. In the United States, this is controlled by the Federal Reserve Bank for the purpose of achieving macroeconomic goals. The money supply is the supply of currency, checking account funds, and traveler's checks. These items are counted as money because they are used as a medium of exchange for the purchases of goods and services. The economy is a complex aggregation of many different types of markets. For example, households sell land, labor, capital, and entrepreneurship in the resource market in exchange for resource payments such as wages, interest rates, and profits. Businesses produce goods and services to sell back to households on the product market. The loanable funds market coordinates borrowing and lending between savers and borrowers, which is not shown in the diagram below, but is shown in the diagram in your textbook. The government uses tax revenue to supply services to all other actors, such as businesses and consumers. In addition to the domestic flow of income, we also have imports and exports from other countries to the United States. Finally, we have a foreign exchange market, which we will cover in more detail later, in which the currencies of different countries are traded. Currencies are quoted using the exchange rate, the price of one unit of foreign currency in terms of our domestic currency. So let us begin by building a basic macroeconomic model. We want to look at the supply and demand for all goods and services in an economic system. One way to accomplish this is to derive aggregate supply and aggregate demand functions to build a goods and services market for an entire economy. We begin by looking at aggregate demand. This is a downward sloping curve showing the relationship between the average level of prices and the quantity of domestically produced goods and services all economic agents are willing to purchase. First, we need to have a more detailed understanding of what aggregate demand is. In the aggregate goods and services market, the price level is the average level of prices for all goods in an economic system. It's not the price of a single commodity in a single market, as we have looked at before. Also, the quantity in this model is not for a single commodity, but rather a real output of all goods and services produced, also known as real GDP, or gross domestic product. The aggregate demand function basically adds up total demand for goods and services among all consumers, investors, governments, and foreigners. There are three reasons that the aggregate demand curve is downward sloping. First, a lower price level will increase the purchasing power of money. If the average level of prices falls by 20%, your $2,000 in your bank account will buy as much as $2,500 would at the old price level. Secondly, a lower price level will reduce the demand for money and lower the real interest rate in the economy. Economic agents will need less cash for their purchases. This includes businesses and consumers, and increased savings will lower the interest rates. With a lower interest rate, consumers and businesses can borrow more at cheaper prices and increase consumption and investment spending. Number 3, all else constant, a lower price level will make domestically produced goods less expensive relative to foreign goods. So we will substitute for more of our own domestically produced products instead of importing more from overseas. Now that we have taken a look at aggregate demand, we have to look at supply from domestic firms. Aggregate supply curve is the curve showing the relationship between a nation's average price level and the quantity of goods supplied by its producers. In the short run, it is an upward sloping curve, but in the long run, the supply curve is actually vertical, as it represents the potential output of the economy. The supply curve is upward sloping in the short run because higher prices induce firms to increase production. That is, their profit margins are higher because of their fixed lower resource and input costs. But this only lasts in the short run, as eventually those resource costs for land, labor, and capital are fixed at relatively lower levels. Once these prices adjust, aggregate supply will decrease, reflecting higher wages, interest rates, and capital costs. Thus, the long-run aggregate supply curve shows the maximum sustainable output for an economy. We can put the long-run average supply curve, the short-run average supply curve, and the aggregate demand function into the same graph to build our complete model. The short-run equilibrium occurs when our short-run aggregate supply curve intersects aggregate demand, and the corresponding price level in GDP will be a point where quantity demanded will exactly equal the quantity supplied by domestic firms. However, long-run equilibrium will only occur if our decision makers correctly anticipate the price level in the economy. So if we have unexpected changes in the price level, decision makers, such as workers who make long-term contracts for their salaries and resource suppliers, will want to renegotiate their long-term contracts to bring the economy back into long-run aggregate supply, or back to potential GDP. The previous example showed us what the model looks like when we're in long-run equilibrium, but what happens when actual output deviates from potential output? In the example below, aggregate demand has decreased in the short run, causing a lower price level and lower real GDP. This often occurs during recessionary periods. This reduces demand on resource suppliers, who now will reduce their resource prices, such that employees are willing to work for a lower wage rate to get a job, and input suppliers reduce costs. Thus, the short-run aggregate supply curve will eventually shift right and increase once resource costs decrease for the production of goods and services. This will bring our economic system back to potential GDP, which is equivalent to long-run average supply, aggregate supply. It's important for us to take a look at a few markets that are operating in the background of our goods and services market. First, we'll take a look at a resource market. A resource market is a market for inputs into the production process. A labor market, which is shown in the diagram below, is a major type of resource market. The number of workers represents the quantity on this resource market, with the price being quoted in wage rates. So we can see at the intersection of supply and demand, we have equilibrium at W star and N star, which is the number of workers. In this market, the wage rate is such that the quantity of workers supplied equals the quantity of workers demanded by domestic firms. Equally important is the loanable funds market, and this market represents the supply and demand for loanable funds. Demanders are those wishing to borrow funds, such as businesses and households, and suppliers are savers that wish to loan funds to earn interest. The price of borrowing money is referred to as an interest rate. It is a percentage of the amount borrowed that must be paid to the lender in addition to the repayment of the principal. For example, if I borrow $1,000 at a 5% money interest rate, I must pay back $1,000 of principal plus 5% or $50 for each period of the loan. This incentive induces savers to lend money to borrowers. In the diagram below, the supply curve represents our quantity of loanable funds that are supplied at each interest rate. The demand curve represents the demand by, again, firms, households for loanable funds at each interest rate. And the point at which the supply curve intersects the demand curve will determine the equilibrium interest rate and the equilibrium quantity of loanable funds traded in the market. However, all interest rates aren't created equally. We'll take a look at what a real interest rate is. The previous example assumed that there will be no inflation. If economic agents expect an increase in future prices, they will build an inflationary premium into the interest rate. This premium compensates the lender for the expected decrease due to inflation in the purchasing power of the principal and interest during the course of a loan. That is, as a lender, I am not as willing to lend at a given interest rate if I expect my return to be less in real terms, in terms of real goods and services that I can buy with my return. So I will need a higher interest rate to compensate for reduced purchasing power. This real interest rate is equal to the money interest rate, which doesn't adjust for inflation or price levels, and we subtract the inflationary premium, which is simply the expected inflation rate. The last major component of our economic system is known as the foreign exchange market. It is a market on which foreign goods and services are traded between countries. In this case, we're looking at the exchange of foreign currency. And the market for foreign currency is based on the supply of currency that comes from our exports and capital inflows, and the demand for foreign currency, which comes from imports and capital outflows. The equilibrium price is the exchange rate. The exchange rate is the price of the pound in the case of UK and United States example in terms of the US dollar. Changes in the supply and demand for pounds will cause appreciation and depreciation of foreign currencies. For example, if we see an increase in demand for the pound, the exchange rate will increase. This means that it now costs more US dollars to buy each pound of British currency. However, this will also mean a depreciation of the US dollar in terms of the UK's pound.